Did you know that there was a lot of volatility in the US stock market last week? And a lot of people now are anticipating that probably we are in an economic recession. So, welcome back to this channel. Today, we are diving into the state of the US stock markets. And also, investors like you and I may be wondering, how do I make money in this downturn, or how do I position myself in this current market condition? So in this video, I'm going to share with you what I think, including some exciting highlights for the past week and what I think about what is going to happen. Now, I do want to just highlight that this video is meant for educational and entertainment purposes only, and it should not be taken as investment advice. But should you want to learn more about investing, I am very much happy to connect with you. I will share my contact. You can tune in to my channel and also come to my website, www.streetwiseeconomics.com, wherein I share some insights and I can walk you through how to invest in the US and Canadian or even other parts of the world. Now, for those who don't know me, my name is Isaac Jonas. I'm an economist. I also wrote a book, The Intelligent Millennial Investor, wherein I share some of my insights on how to invest in the market. And over the years, I've obtained some scholarship awards, particularly the University of British Columbia, to further my education. Now, with regards to the major economic data points that were released in the US, there was quite a lot of activities. The highlight was the Federal Reserve did not change the interest rate, but in their summary, they indicated that they are prepared to cut the rates only if the conditions such as, inflation is down and the job numbers, and they see that it will not reverse the gains that they have made on the front to reduce inflation. So what then happened is that a lot of investors then were excited that there was this talk that there is the possibility of reducing interest rates. But then now, people, when they digested what the Fed chair and the Federal Open Market Committee had said, some people started to worry, to say, well, other central banks, mostly in the advanced economies, have already reduced their interest rates. Maybe it's a little bit too late. So probably that could be a reason why people then started selling off. So you see, on Thursday last week, I was actually in Washington, D.C., and I saw that the volatility index actually it went up because a lot of people were panicking and they were selling off. Companies such as Amazon, even though they had, fairly good results in their earnings, it dropped by 8%. Berkshire Hathaway actually had a, like 15% growth in terms of their earnings. And yet, when you see at the market, as I will show you with the data, there was a lot of talk about the possibility of a recession. The National Bureau of Economic Research, which is a non-profit in the US, actually looks at the economy as a whole. Indicators as payroll, is the economy, GDP growing, right? And then they determine, but usually it is a lagged indicator. What does that mean? It means that by the time they pronounce to say, okay, these past 2 quarters, we were actually in a recession. Usually what people do is they already, the market will have already started maybe recovering. In other words, the economy or the stock market. What some people may confuse is that the stock market, you are looking at the publicly listed companies, right? But it's only part of the economy. So they are the private sector, but also different sectors. So the economy is only, the stock market is only a fraction of the whole economy, but it is actually a good indicator of generally what people are thinking about. So what then happens is that sometimes a lot of people start to fear and panic to say recession because some people will lose their jobs. Some stocks, which may have a lot of leverage and a lot of debt, might actually not even recover from that. So it might possibly extend in some cases for months and a few months in 2020 when the COVID pandemic happened because of what is called as quantitative easing. Governments, they started printing money and lowering interest rates, the central banks, mostly in the advanced countries, and it boosted the economy because people had money to spend. So the economy quickly recovered. So I say this to just explain and give you context to say whether there is going to be a recession or not. You can see that the unemployment rate actually, analysts were forecasting 4.1. It came last week as 4.3. So the key here is that a lot of people, in as much as they try to say, I predict a recession or the market is going to go this, nobody really knows. People can just wake up and they are freaking out, or there is uncertainty in the Middle East. So you can see that on the screen, the S&P 500 on Friday alone, it was 2.37% down. The Nasdaq now, it is in the correction territory. It dropped by 10% if you look at the past couple of weeks from the previous high. So what it means is that this is common, this is normal, right? But a lot of people panic because people were saying that some people, they had what is called yen carry, trade carry. In other words, what people were doing, some investors were doing, they were borrowing money in yen in Japan, right? Which had lower interest rates. And last week, the market dropped, and the perception that maybe the Bank of Japan might possibly increase interest rates, right, has resulted in those people who were borrowing money, it's possibly, right, because we don't really know. But looking at the data, these people were then using this money, maybe just putting it in the treasury bills in the US or in Canada, where maybe you're getting 4 or 5% per year. So people were making money that way. And then if you compare with inflation, so now those people who were borrowing, they might have been freaking out. Some people, usually, I tend to wonder, like, why are people freaking out if this is just 3% or 5%, right? As a long-term focused retail investor, I'm so excited because it means a lot of wonderful companies would be discounted. So it would be good time to actually buy for long term. So what I tend to find, because I go on social media, including X, some people may be using leverage. In other words, they are borrowing, on their margins. Let's say you have money that is invested in Canada. We have the tax-free savings account. So you have, let's say you have 50,000 there. They can give you maybe 2 or 3 times to just borrow for interest rate, maybe 5%. I'm just giving as an example. So what happens is it works if the market is bullish, it's going in your favor. If you are betting that the market is going to go down, then that's good. But a lot of people now, when they borrow and you lose that money, it means you still owe that money plus the interest. So despite the common sense that when the fundamentally good companies are dropping, it would be good time to buy. A lot of people now, they freak out and they sell at the bottom, they lose. So I suspect sometimes that these are some of the things, the lessons that I've learned, that it's better for me if I have 1,000 or 2,000 to consistently invest over time than borrowing, because borrowing, it can be tricky. For some people, it works. I'm not saying that's something that is bad. Now, usually most people, when the equities market, that is stocks, they drop, a lot of people, they then go to bonds, and to kind of use it as a hedge. And so what then happens is a lot of people, they then go there, and then it means the bond prices might go up. So what I've learned over the years is that as an investor, you should always think, broadly, because once things are in the news, it means usually they are algorithms, right? The prices, you see that they might be already reflected. So when the market was hitting all-time high, for me, I was thinking like, okay, the VIX, the volatility index that tracks the volatility, it has ETFs that track the volatility index. They were dropping because they are negatively correlated. In other words, when the equities market go up, they go down. It was down. So I was kind of like buying and also selling some of the positions that I thought these companies I own were a little bit overvalued. So a lot of people, what they do is they chase those, huge gains. But by the time that they get in, they then, lose money. Because I was looking at companies such as Broadcom, even, Amazon dropped by 8% this past week, but still it went to almost $200, right? So now imagine if someone got in at $200. Now it was like when I checked, it dropped to even 165. It's just a fluctuation. It might even go up next week or so because it is the fundamentals that are strong. I'm talking about Amazon as an example. So as a long-term focused investor, what I am focused on is looking for fundamentally strong companies, right? And fluctuations happen all the time. And I say this on my channel, right? So I also like to have a diversified portfolio. In other words, I like to buy exchange traded funds that actually track, let's say the S&P 500 in the US. So that means I'll have part of Apple if Nvidia is doing well, and some sectors like the financials are doing well. But as you know, Nvidia, the semiconductor sector, has been doing well. So I can still get the benefits of doing that by just owning the exchange traded funds. In other words, those funds that track the S&P 500 or the Dow Jones or the Nasdaq, without overly being exposed to one individual stock. Because now it means those people who were invested, let's say in SMCI, or those companies that have dropped by 40, 50%, it means they are really, really down if you are invested in those individual companies. And I'm not saying it's not possible to do well, but I've seen that over the years, if you look at the data from 1923 or 1928 for the S&P 500, only 5% or so can only beat the S&P 500. So I can put most of my money in the S&P 500, let's say 50%, and then I go on individual companies when they really drop. So I look at companies, in the interest of full disclosure, I own Microsoft as well as an example. It has been doing really, really well. But at the end of the day, the idea is I like to get in when it is down, right? 40, 50%. And then I can average down. But the other thing is that if I look at the S&P 500 index, that is SPY, I also own SPY in the interest of full disclosure. But Microsoft also maybe has 6 or 7% as an example. So it has exposure to all these technology firms, uh, different sectors. So I find it very interesting in the sense that index funds through exchange traded funds, they are actually very good because once a company stops doing well, it's removed from that particular index, right? By the committee that decides that. For the S&P 500, the Dow Jones, there's a committee that sits down and then decide based on specific benchmarks. So this is to say that it is very, very important from what I've seen to say whether there's a recession or whatever is happening in the economy, to not only think about investing like the returns in the market, for example, the equities market, in the sense that the market is going to go up and up. It doesn't happen that way. It goes up and down. Sometimes it goes down 20, 40, 50%, 47%. It happened actually in 1930s, what was called the Great Recession, right? 47% at that time, and it has happened. And what excellent investors do now, they manage the psychology. They now invest in those companies, right? That they understand when they are hugely discounted because people start to panic, and then they sell off at the bottom, and then they get in for the long term. So that's the whole idea. So I thought I would just share this, that, trying to time the market can be challenging, but also timing the market is good, because if the Nasdaq is dropping, the S&P 500 is dropping, and I am of the view that over the long term it's going to go up, I simply average down. I buy more shares when it goes down to certain levels. So that's my approach. So I thought I would just share this with you. And my YouTube channel is Streetwise Economics. If you want to connect, I thought I would just share this with you. And my website is www.streetwiseeconomics.com. So thank you so much for tuning in, and may the markets be with you. And if you haven't subscribed, please do so, and feel free to pass on comments on the comment section and let me know what you think. Are we going in a recession or not? Thank you so much again for tuning in, and may the markets be with you. Have a wonderful week, and I wish you success in. Thank you for tuning in to this podcast. Only 31% of the people who tune in to watch this podcast, they are subscribed. So I want to encourage you to please subscribe so that this content can reach far and wide. Thank you again, and may the markets be with you.